Alphabet and Nvidia alone make up a third of the S&P 500 gains this year. Clients and financial professionals disagree on health issue discussions and the advisor's LTC planning dilemma. That and so much more on this week's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimpson and Casey Elkins.
Welcome in to Elevate Your Wealth. Your hosts, Mark Stimpson, Casey Elkins, and Steve Flynn. You can find them right here in Seattle, Elevated Financial Management. They are certified financial fiduciaries, helping hundreds of their clients get ready for retirement. It's all about the plan. I'm Morgan Patrick, a pleasure to jump on. And this show, we get the latest and the greatest when it comes to financial news, retirement news, and we end up talking about it, how it's going to pertain to you. We also give you an opportunity to get on their calendar, complimentary appointment. Again, there's no cost to it, and there's no obligation to become a client, so stay tuned. We'll open those up here in just a little bit. And I also want to give you a website. It's a resource, efmnw.com. It's all letters, efmnw.com. Links to the TV show, our radio show, and podcast form. There's a ton of information on retirement, background information on Mark, Casey, Steve, and the team, and it's an opportunity for you to learn, but also an opportunity for you to contact, get in touch, and set an appointment with them and talk about your retirement. All right, so articles, guys. I always do this before we jump into our first one. How was the week? And we'll just go Mark, Casey, Steve. Go.
Well, this past 3-4 days, it was pretty good. I was in Spokane with my middle son. He got his first house, so we were working on doing some remodeling, doing some painting on that. So that was nice. Had fun in Spokane. I hadn't been in Spokane. I know Casey's got some history there at Lake Coeur d'Alene, not too far away from Spokane, of course. And so it was just nice to spend a little time with him. I don't get to see them. In fact, we figured out it had been almost 5 years since I'd been over there with my wife. So anyway, yeah, it was
Beautiful part of the country.
It is.
Beautiful part of the country.
Beautiful. It's actually, Spokane's a nice little town. So hit up a couple nice restaurants when we were there, and then back home, and I waited late to come over the pass, so I didn't have to deal with much traffic. So yeah, it was a good 4 days of doing something a little different. Now it's back to helping everyone get retired and enjoy what they've worked so hard for, and make sure that it's success. That it is a success for them.
Yeah. Well, back when I traveled with Duke, we went played the Zags.
Oh yeah, Gonzaga.
We had some fun in Gonzaga in Spokane. So anyway.
I like the way you say that. Say it one more time.
Gonzaga, Spokane. Now we had a wonderful time. What a beautiful, beautiful city. Casey, how about you?
Mm-hmm. Really busy. Actually, just kind of worked around the house. Took advantage of the long weekend and did some, I guess, winter cleaning. Although it felt more like spring cleaning. So just getting things taken care of around the house, and nothing too exciting. Nothing too crazy. We're doing a little remodeling here at the office, which is exciting. So we're making some adjustments there, and just trying to get things wrapped up before the year is over. And still lots to do, right? Still lots of Roth conversions, still lots of things to take care of for clients too. So we got a lot cooking, but it is kind of an interesting time of year where things start to wind down a little bit.
Yeah.
But I will say it doesn't ever really feel like we get away from being busy. It seems like it just keeps going, which is a good thing, right? We're really happy to be in the position we're in to help the folks we get to help.
Yeah, I was going to say, you're in the community. People need help, and that's why we do this show. It's why you do your TV show. It's why the firm is there to help with planning. Steve, how was your long weekend?
It was very nice. Thank you, Morgan. Yeah, my boys, I live in Kirkland, Seattle, and my boys live in Portland, so I spent a lot of time on the I-5. That's the way it goes. Yeah, quite a lot of time on the I-5, but that's fine. It's okay. We had a great time together. And just like Casey says, yeah, it's kind of Roth conversion time, RMD time. So, yeah, it's quite busy for us right now.
Okay. Well, I'll tell you, we're going to get into an interesting discussion. And the first article you brought to our attention, and the listeners will be intrigued with this, and that's Alphabet and Nvidia. Nvidia, they alone make up a third of the S&P 500 gains this year in a sign of big tech's dominance. But, I mean, this is kind of what we've been following. I mean, this is where a lot of eyeballs are.
Mm-hmm. Yeah, and, I think this is pretty well known. It's not necessarily that this is maybe a big surprise to folks, but it really does catch our eye because we've got really just two companies that make up a third of the growth of the S&P, right? And I think that's really the way to look at it, regardless of what the companies are. And so, I think at the end of the day, the way that we could really look at this is we have Alphabet, which is Google, right? That's Google's parent company, and Nvidia. And I don't think any of us here have concern that those companies are going to disappear tomorrow, right? That's not what we're talking about. But could they have a downturn in their market value? Absolutely, right? Could it be substantial? Absolutely. And if you're 20 years from retirement, then maybe it doesn't matter too much to you. Of course, you don't want to experience that, but it may not have the same impact for those that are close to retirement. And that's why we're focused on this, because if you've got two companies that drive 30% of the growth, you could have two companies that drive 30% of the loss. Yeah. Right. Exactly. I mean, it goes both ways. Yes. And so, and the other thing to think about there is, and we've talked about this before, where I think it was 11 companies made up like over 60% of the growth of the S&P or something like that. I don't remember, or 60% of the weighting of the S&P. Yeah. That's what it was. Yeah. And so the thing to consider there is that you might, if you're buying S&P 500 indexes, and that's how you're investing, you might actually be really overweighted into certain stocks and not realize it, right? Yep. Sure. It feels diversified because you hold 500 different holdings, but if, 60% of the money that you have there is founded in 11 companies, it's not equally weighted across the portfolio. And that really can be a recipe for disaster.
Yeah, in fact, we talked about this last week. Steve comes from the Morgan Stanley world, and they wrote a great article on one of the big sections of Morgan Stanley that deal with high net worth families. They manage several $1 billion for these families, but the bottom line was their big concern is, leverage and over concentration. And that's really what we're talking about here, right? Like Casey said, it can lead to a disaster because I love what the article said, all runs come to an end, right? And that's something we've been on such a bull run for a long time, but a couple of these companies start to struggle a little bit, especially with what's going on in the AI world. This could really devastate a lot of 401k plans and portfolios right now. And over concentration is something you need to be concerned about, because that train is going to pull into the station one of these days, and hopefully it's just not going to slam into the wall, which could easily happen. We've seen it too many times over the past several, decades.
Yeah, right. That's it. And another piece from this article, it says big tech stocks represent 49% of the S&P 500's total gain for the year. Right. That's huge, right? Yes, because now if you really kind of put that under a microscope and focus in on what that truly means, is that the majority of people, because most people are invested in the S&P 500, and if they're not, then they're probably invested somewhat in the NASDAQ, some in the Dow. But collectively speaking, the majority of folks, their holdings are in the S&P, whether they realize it or not, especially if you're in a 401k or a 403b. You see the value fund and the growth fund and all those things. Most of those are founded on the S&P 500. So that being the case, now that means that you're very tech heavy in your investments. And here's the deal. Tech is the best place to be when it's going well, and the worst place to be when it's not. And so that's really our concern, right? Because we're focused on retirement. I think that's our big takeaway from this, right? When we look at all of this, we look at it through the frame of retirement, through the lens of income. And investments that are highly volatile do not do a great job of producing income. It's really easy to take income out of a portfolio that just returned 16% last year. That's no problem. But what if it lost 16% last year? What if it lost 20 or 25 or even more, right? The average bear market loss is bigger than that. It's 39%, almost 40%. So that's where it really comes down to diversification. Sure. We're not concerned that Google's not going to be here next week. We're not concerned that Facebook's going to disappear and Apple's going to disappear. That's not what we're talking about. But could they absolutely have a loss in their market value? 100% they could, right? I mean, we all recognize that that's possible. And oftentimes when one of them moves, the others move as well. And we have so much money being poured into AI right now. And that's where a lot of these companies are getting their growth, is from that AI investment. So if there's any hiccup in that AI world, that potentially has a cascading effect to everything else. And it's something that we really have to be prepared for.
Well, and we're seeing the fear of missing out right now, right in front of us. Everybody's wanting a piece of it. That's where the growth is. They're all going to be there. You need balance. You need diversification. I mean, this is your money and this is your retirement. Opportunity right now to have this kind of conversation about your portfolio, and you can do that with Elevated Financial Management, complimentary appointment. Casey, kind of walk us through exactly what's going to happen.
You know, if this is for folks that want to figure out how they're invested. If you're looking at your 401k and your 403b, or maybe if you have an advisor and you're looking at your statements from there and you just don't quite understand how you're invested and the risk that you're taking, or you want a second opinion and you want somebody that can help explain these things in plain English to you, that's exactly who this is for. This is your chance to get that analysis, to sit down, have a one-on-one conversation and figure out where you're at and where you'd like to be and how to bridge the gap between the two. If you're 5 to 10 years from retirement, you've saved $250,000 or more, this is your chance to get a written financial plan. Don't hesitate. Pick up the phone and give us a call.
Here's the phone number. Again, remember, if you're 10 years out, if you're 5 years out, this is a time to see if you're balanced, see if you're diversified. And if you don't have a plan, start rolling on it. Or if you need that second opinion, grab one of these appointments and do it now. 866-668, that's 3625. That's 866-668-3625. It's a complimentary, no obligation appointment. See if you're on track for your retirement. And you can do that with Elevated Financial Management by calling 866-668-3625. When we return, we're going to talk about the next article, and that's clients of financial professionals disagreeing on health issue discussions. We're going to discuss when we return. We are back on Elevate Your Wealth, powered by Elevated Financial Management right here in Seattle. Our hosts are Mark Stimpson, Casey Elkins, and Steve O. Flynn, and they are helping hundreds of their clients get ready for retirement. They're certified financial fiduciaries. I want to remind everybody, too, we have the complimentary appointments. We're going to tell you more about the book, Break the Glass. You can get a free copy simply by going to breaktheglassbook.com. Get signed up there. They'll ship out that book to you. Again, it is no charge. That's Break the Glass, and it's breaktheglassbook.com to sign up for that, and it's a great resource when it comes to retirement planning. I'm Morgan Patrick. We hit the latest articles that are out there. We've talked about Alphabet and Nvidia and just how they are really impacting the top part of the S&P 500, the growth, and make sure that your portfolio is balanced, not too heavy, not too fear of missing out themes in that portfolio. We've talked about that already today, guys. And now we're going to move to clients and financial professionals disagree on health issue discussions. Why did this jump out at you? And I think that's interesting that you're disagreeing with clients on this.
Yeah, this is something that really hit home with me, Morgan. I just lost my mom a couple of weeks ago, and she dealt with a lot of the things that we're going to talk about in this article. But I think what is staggering here, and I hope our listeners pay attention to this segment, is there was a study done by the Alliance for Lifetime Income by LIMRA. LIMRA is an organization that almost like consultants in the insurance industry. They do a lot of very unique studies on retirement, lifetime income sources. But I think what stands out to me is individuals, financial planners, are having discussions with clients. And when they survey the clients about these discussions, close to 50% are believing that they never happened. Listen to this statistic. It said 96% of financial professionals said they discussed physical health issues with clients, but only 44% of the clients remember having such discussions. 90% of financial professionals said they talked about cognitive decline, but only 31%, so basically a third of the clients said the topic was broached. Now that is a bit of a disconnect, right? And we
either that or that's living proof that we're having cognitive decline.
Exactly.
That might be that too.
You almost have to wonder about that, right? Because this is something that is the first 15 years of my career, all I did was Medicare and long-term care planning. Yeah. So this is very, very real. And I've just seen clients. We have a client right now that's going through over $20,000 a month now, pay for the long-term care that they're dealing with family members. And so this is something that if we just avoid it, or we say, oh, I didn't have that discussion, and then we go into crisis mode, when it happens, emotions get involved. And I tell you, I kind of went through this. Fortunately, it was a very short period of time. My mom didn't last very long once she went on hospice. But the point is, it could have, for people that are dealing with Alzheimer's or different forms of dementia, it can be a whole different ball game, right? And when Medicare, so many people, even today, still want to believe that Medicare is going to cover them for, a level of care that's just basically help with what we call ADLs, the activities of daily living. And that's absolutely not going to be the case. You may get up to 100 days with Medicare, but you must be on a skilled level of care to do that. And so that's basically a little over 3 months. We all know that, right? So again, having these discussions and then planning, which if something's going to blow up a really good retirement plan that we've put together, it's going to be LTC. It's going to implode. And it'll be like Chernobyl going off inside of your plan. And there'll be a lot of repercussions that you may never recover from by just avoiding this or not wanting to talk about it. It's that serious today.
Yeah, it is. And it's something that, this is really interesting. And I can say that we've experienced it here, where we do talk about these things with clients. And oftentimes, for whatever reason, the recollection of that is relatively low. And I think it's kind of twofold. One, it's not fun to talk about, right? No. So it really isn't fun to talk about aging and what's going to happen and the cost and that. So, you know what is fun to talk about? Retirement. And you're going to have the income that you need, and we can solve this problem and that problem. That is fun to talk about. And so that's what gets remembered. And that's great, right? Because we want to be positive. But at the same time, we have to be realistic, and it is something that has to be dealt with. Right. And so this is something that has to be part of reviews with clients, right? It is not just an initial conversation. And if that's where you're at, if you're not having reviews with your advisor, that's a big concern for us, right? That's something that we need to be reviewing what's going on and having those discussions to make sure that we're keeping up to date with what's going on in your life, right? That's really what it comes down to. You want to add something, Steve?
Yeah, we do have that subject that we kind of bring forward, but it's I find the people that bring that subject to us about long-term care, people that have experienced it in their lives with their parents. They may have had an event with their parents when they saw the cost of care in those last few years. And it's interesting when we're in that situation, that they actually ask us about long-term care and what provisions can be made for that. And they may have a policy in place already. I think, it's an important conversation to have for sure.
I think the dilemma is that so many people don't want to talk about this, right? And they don't have a real clue as to how bad it can really be. I love this last sentence here. It says, there is a marked difference in the perception of retirement risks between financial professionals and their clients. That's it right there. They're not wanting to talk about or deal with that risk. And if you don't, it can really end up backfiring. So I hope everybody's listening, because this is something you want to be talking to somebody that specializes in this so they can help you avoid what could be a disaster.
Yeah, I think you guys have hit on something. Casey, you said it early on. It's like we like to plan for the trips and visiting the grandkids and planning for the fun stuff, the stuff that makes us smile and laugh and just enjoy retirement. And we tend to pass over or not pay attention to detail on things we don't want to deal with. And talking about your demise, planning how you're going to handle the end, most people, they don't want to do it. And you brought up a great point, Mark. I mean, as advisors, you sit there, you do this every day. So it's front of mind. We're dealing with people that are planning for retirement that they don't do that every day. So I can see how advisors, they can hammer this because they know it. And then people that have become your clients, it's almost like they have to be reminded as the review, as you mentioned, Casey, just having it in the plan, have it built in there, have it in writing, how it's going to go. That way, there's no way to forget it.
Right. In fact, It's funny, you just mentioned a little bit of this, Morgan. I love this. So among consumers who work with a financial professional, here were their top 3 concerns in order. So one was inflation, the second one was healthcare costs, and third was outliving savings. Now let's flip this and talk about the concerns that the financial professional has and the order he puts them in. Number 1, they put outliving savings, okay? And I tend to agree with that. That's number 1. Number 2 is market volatility, because that can eat up and be way worse than inflation over time, right? And the last one is healthcare costs. So again, there's a disconnect between what financial professionals are considering to be your greatest worries versus the consumer. And so this is something we're trying to educate, which we do it at the colleges, why we're on the radio, why we're on television, is to help educate about what the true problems are and how we can address them. Inflation does need to be addressed, there's no doubt about it. But if these others can be way bigger of a problem if you're not careful.
And it's something too where it comes back to, like you mentioned, Morgan, right? It is something that we do every day. And you know, if you have another advisor, your advisor does every day, right? So his idea or our idea of what should be top concerns may be very different from what your actual top concerns are. And I think that's something where if your advisor is not to some extent challenging your thinking in that way, are they really your advisor or are they just an order taker, right? And that's not what you're looking for. You're looking for somebody who can be a source of truth for you and bring to the table things that you haven't thought about or highlight things that you have thought about, but show you what the real impact is. And that cannot be understated. That is such an important piece of what we do.
Mark, we've got spots on your calendar. Walk us through what's going to happen.
Yeah, so if you're listening and maybe you're getting ready to retire from Boeing, you've saved at least $250,000 or more, these strategies are going to work best for you. But please, all we want to do is have a conversation. You're going to leave your checkbook at home. Let's talk about taxes a little bit. We haven't talked much on that today. We've been talking about long-term care. How can I address that when it comes to my retirement? Do you have guaranteed sources of income? We know that maybe you're worried about Medicare, what to do there, when should I start Social Security early or not? That and so much more can be discussed if you come in. Let's just have a conversation. Come and see us and let Elevated Financial Management give you a hand.
All right, we've got the appointments. Call this number, 866-668-3625. That's 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Get a handle on it. Have a plan. Make sure you're prepared. 866-668-3625. And if you need that second opinion, you can absolutely grab one of these appointments. No cost, no obligation. 866-668-3625. When we return on Elevate Your Wealth, we're going to continue the discussion when it comes to health care, but it's going to focus in on long-term care and the dilemma that's coming up next. Back on Elevate Your Wealth, powered by Elevated Financial Management, found right here in Seattle. Your hosts, Mark Stimpson, Casey Elkins, Steve O. Flynn. Check out the website, efmnw.com. Again, all letters, efmnw.com. It's a resource. There are links to the TV show, radio show, and podcast form. Just good information on retirement planning, background information on Mark, Casey, Steve, and the team. And it's all about helping their clients get ready for retirement. They're certified financial fiduciaries. I'm Morgan Patrick. A pleasure to jump on. We got a couple things to be aware of. We're going to talk about a book a lot today, Break the Glass. We'll tell you how you can get a free copy of that, but we're also going to give you an opportunity for a complimentary appointment with Elevated Financial Management. Stay tuned. Come in, talk about your situation. Maybe it's sitting on a portfolio, or you're halfway down the path with your planning, but you're frustrated and need a second opinion. You can grab one of our appointments. Now, as we do each week on this show, is we grab the latest articles when it comes to planning, when it comes to retirement, things to be aware of, things that will make you question maybe what you're doing or not doing, and we'll give you that opportunity to grab one of the appointments. The next article that we have in front of us, gentlemen, the Advisor's Long-Term Care Planning Dilemma. What is your dilemma?
You know, I really appreciated the way that this article started. It mentions that oftentimes long-term care planning, that conversation begins with fear. Fear of the cost, fear of health decline, losing independence. And you know what? I'll say this. I think advisors that start the conversation in that way really do mean well, right? Because the idea is to like raise awareness and to help people understand that this is something that has to be taken seriously. And it really plays into what we just talked about in the previous article, where advisors talk about healthcare and long-term care, and the client oftentimes doesn't remember it, right? So it's meant to be hopefully a memorable conversation, and that's probably why it starts this way. But we found what this article says to be true, that long-term care planning, for it to be effective, really comes from a place of flexibility, right? There are different ways to address long-term care that didn't exist 20 years ago, right? And so the idea that a lot of people have in their minds of how we deal with long-term care and what the cost is and how it works and those kinds of things, yeah, there are policies that are still like that, but there's also a lot of options that are not like that at all. And that's what we're going to talk about a little bit today, is about how there's different ways to go about it that do give you more flexibility and ultimately are a better option most of the time for folks, because if you do pass away without using the long-term care, that money doesn't just disappear, right? The insurance carrier doesn't keep it. And that's really the key. And that's, I mean, at least in the conversations that I remember, I assume probably the same for you, Mark, and for you, Steve. When we talk about this, that's people's biggest beef with long-term care is, if I pass away and never need it, then I paid all that money for nothing.
Use it or lose it.
Yeah, right. And that's a frustrating idea. It's a frustrating concept. And we get that. It's frustrating for us too.
Yeah.
And so that's why we want to talk about some of these other options.
I just want to add a quick story. I had a partner up in Bellevue for years, and we had a situation with one of his clients, went into long-term care, and it was bad. The husband developed dementia, and it began to really eat at the estate. Well, the children, 2 children, came after my partner because they felt that he didn't basically force them to buy insurance. They saw their inheritance flying out the window and wanted to blame my old partner, and it wasn't right. And fortunately, he had a piece of paper in the file that showed that they had talked about this. This is one of these things we've been talking about.
Sure.
And so for those of it that are listening, we want to protect you, but we also want to protect ourselves from this happening. And it's that serious. And I like what Casey just mentioned. Sometimes when a good advisor could look at an old plan, and if it's got good benefits, the premiums have stayed fairly stable, the best thing may not be to replace that, right? It could be very well the best thing in the best interest of that client to keep what they have. We don't know until we look at it, right? But I believe a good advisor is going to take to heart and really going to look at that so that they're not trying to just make a sale, but do the right thing for the client.
Well, you're a fiduciary.
That's exactly right.
We say this every week. If you are out there and you're sitting on a plan, let's say just referencing what Mark's talking about, you're sitting on a plan and you have maybe long-term care in there in some form or fashion. As fiduciaries, if you come in for a second opinion and that part of your plan looks good, looks like it's in the right spot for what you need, as a fiduciary, you guys are going to say, you know what, I wouldn't change that.
Yeah, exactly.
But as you mentioned, Mark, if something in there is maybe old, something that could be updated, changed, pivot, tweak, whatever you want to, phrase it as a fiduciary, you can also offer up that information. So people feel like they're kind of stuck and they don't know. I mean, it's about finding out more information, gaining knowledge. That's the power.
Yeah, I just think that the use it or lose it has been a thing that has really stuck in a lot of people's craws about that. And the wonderful thing today is there is other awesome alternatives that is going to be the exact opposite of that type of strategy, to where if you don't use it, you don't lose the premium that you paid in maybe for decades. And I think, did you want to add something to that, Steve, about that?
There's so many, good options that really people are not aware of. Because it's a conversation you don't really have. You don't really want to talk about long-term care and so on. And as I say, people do come into the office sometimes having an experience of the expense of that and bringing that conversation to us. But also it's the use it or lose it. Most people think, I pay a premium. If I don't ever use it, that premium's gone. But there are other options. And I'll just share a couple of those with you. There's the hybrid life long-term care policy. So the way that works is you do pay a premium, but that premium acts as a multiplier for life insurance. And life insurance benefit is tax-free. I mean, it's a great benefit to have for beneficiaries and for yourself to set that up. And also it has a long-term care element as part of that. And another, that has to be medically qualified. So it's best to get in early. The later you leave it, the more expensive it becomes. Or perhaps you may not qualify. So, it's best to take action sooner. And then there's another option that I'll mention. There are annuities out there that have an income rider. So, they're solving for income. They're giving guaranteed income in retirement. And if you have a long-term care event, some of these annuities will actually double that income payment for up to 5 years. And that isn't medically qualified. So for a lot of people we speak to, that can be just a phenomenal solution, not only for income, but also for a long-term care event as well.
So it's about options. And listen, we're here to help. We do this show to provide information. And if you want to reach out and grab one of our appointments and come in at no cost, no obligation, you're going to get an opportunity to do that. But we also have another resource, Break the Glass. Casey and Mark, you guys decided to put this book out, and there's an easy way to get it, breaktheglassbook.com. Just go there, get signed up. You're going to ship it out. But you do address long-term care in your book.
We do. Yeah. And you know what? The reason it's in the book is because it's something we talk about with every client. And it's something that we believe should be talked about with every client across the country, because it's something that most people are going to deal with in some way. Maybe not you directly, but if you're married, I think it's like 70 or 75% chance that one of you is going to need long-term care at some point. So if that's the case, this is affecting everybody. And as Steve has mentioned previously, if somebody comes in that has had a family member dealing with long-term care, a parent, or even an aunt or an uncle, whoever it is, long-term care is a big deal to them. And we see why, because it can absolutely annihilate your retirement plan if it's not part of it. So in the book, Break the Glass, again, you can get a copy at breaktheglassbook.com. We'll ship it out to you. If you come in and see us here in the office, we'll have it for you. But we do talk about it because it is part of a plan. That's what makes a plan, is that we have tried to account for all of these things, that there are different levers that can be pulled to make sure that no matter what gets thrown your way in retirement, that you can be successful. So the book is meant to be read by folks that are trying to plan for retirement. It's not a textbook. It's an educational piece, just like we talk here on the show or like we do at our workshops at the colleges. It's all meant to be easily digestible. So make sure you get a copy. We think it's a really valuable read. But back to the article, I will say, there's something here that I really want to mention. If you're still working, it's an HSA, health savings account. That is realistically the only way for you to get truly tax-free money. A Roth gives you tax-free money in the future, but you have to pay taxes now. An HSA is truly a tax-free account. It's limited on how much you can contribute, but if you have time there, contribute to that HSA, and the more it grows, the better off you're going to be. And you know what, that's probably not going to be ever big enough to cover all of your long-term care need, but it absolutely could help. And maybe you just use it for medical expenses in retirement, whatever the circumstance is. That's one of it might be the most tax efficient vehicle that we can actually use.
So let's recap. Again, you're out there, you're thinking about long-term care, and if you're not, you should be. So some things to consider. And Steve, gave us a couple: hybrid life and long-term care policies. Also, the annuity, that's there for you. They can have long-term care riders. And as Casey just pointed out, the health savings account, that triple threat when it comes to tax savings, but also really helping out with your long-term care and health care planning as you move into retirement. So important to be prepared. If you've got questions, we've got an opportunity for you right now to get on the calendar with the Elevated Financial Management. It's a cost-free, no-obligation appointment. Case, walk us through it.
Yeah, so this is for folks that want to find out more about long-term care, that want to figure out how that could fit into their plan and the options that Steve mentioned. For folks that want to get a true retirement plan put together, how much income can I take? How much income can I have in retirement? How can I be tax efficient? How can I make sure that I keep pace with inflation and cover medical expenses? All those concerns that you feel, those things that you feel uneasy about that you want answers to, that's exactly who this is designed for. We will sit down and have that conversation with you. We'll design a plan that's custom tailored just to you, and we'll answer all of those questions. So don't hesitate. Pick up the phone and give us a call.
All right. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. The number to call is 866-668-3625. It's no cost. It's no obligation. It's about gaining knowledge. Knowledge is power. 866-668-3625. Again, a complimentary appointment awaits and no obligation to become a client. Again, the number to call, 866-668-3625. When we return on Elevate Your Wealth, it's time for scenarios. We've got 3 of them. We'll throw them at the guys, see what they come up with. That's next. Welcome back into Elevate Your Wealth. Your hosts, Mark Stimpson, Casey Elkins, Steve O'Flynn. You can find all 3 at Elevated Financial Management right here in Seattle. And every single day, what are they doing? They're helping their clients get ready for, prepare for their retirement, and of course, beyond. Certified financial fiduciaries, yes, they are. I'm Morgan Patrick. Absolute pleasure to jump on and talk about these important issues and also give you a couple of opportunities at resources. A complimentary appointment, yes, we have those. We also have a book, Break the Glass. Great resource. All you've got to do is go to breaktheglassbook.com. Get signed up. It's free. They're going to ship it to you. Again, that's Break the Glass, and go to breaktheglassbook.com and get signed up for that. All right, scenario time. And Steve, you are up first. Here it is. A retiree, $500,000 in the 401k, wants to start withdrawals but is unsure if they should take monthly or annual distributions. They want to minimize taxes and avoid running out of funds. What factors should guide their withdrawal strategy?
Oh man, lucky me on this one. I mean, I've got so many questions, but okay. Right. So they've got 500,000 in their 401k and they want to minimize taxes and avoid running out of funds. Wow. Where do we go from there? So, well, I mean, it's part of planning. How much income do you need? And we're always factoring taxes into that, whether how you file, are you single, married, joint? When do you take withdrawals? I mean, monthly if you can't really budget. But again, it looks like, I've got to say it, these people are probably invested in the market. And there's always that risk, isn't there, of when do you take money out? You know, we really hate to have that being your solution for retirement when you're in the market and you're relying on those funds. It's a real tricky one. I don't know. What do you say, Mark? I can see you. I can see you want to add.
What I'm going to say is, if somebody wants to think that they can take money out of their 401k and not pay taxes, I don't know that strategy. Now, what there is one, if they want to kind of give up control, they could do what we call a QCD, a qualified charitable distribution. They could do that, but then they're giving up control of that money to do that, right? And then they can avoid the tax on that. But that doesn't work for most of our clients. There's a few. It could be a really good strategy to use, right? And again, Steve mentioned this. If you want income for life, you better be using a product that can do that, right? And this brings up the famous A word, annuities. It's the only vehicle that we know of where we can put a chunk of money into that product, that annuity, and turn on an income stream that they cannot outlive. It's impossible, and it's contractually guaranteed. So every pension, if you're fortunate enough to have one in the United States, is an annuity contract. Social Security is an annuity contract. And I know how you guys feel about this. I hope our listeners are really thinking about this, but I would take as many annuities as I could get my hands on, right? Because I love the fact that it's guaranteed income. It's a paycheck for life.
Yeah, and the idea here is when to take the withdrawals and how to not run out of funds, right? And that's where Mark comes up with that, and we're in full agreement, right? I mean, absolutely, because it's the only place that you can get guaranteed income for life. Some people want more risk than that. I would say the people that want more risk than that are actually, it's a pretty small pool once they understand how this truly works. But that being said, the biggest thing comes down to how much can you take. That's what this is really about, right? Whether you have 500,000, a million, 10 million, whatever it is, how much can you take and assume that money will last for the rest of your lifetime? And again, on every Gallup poll and Harris poll and whatever it is interviewing retirees, their number one concern is running out of money. And we get why, because people are living longer lives and healthcare is more expensive and the market's more volatile than it's ever been. And the list goes on and on and on of things that are concerning that could make you run out of money, right? So the point being there is we get the concern and there are ways to solve it. But I think the easy answer is you got to have a plan, right? Yeah. Because there are details that we would need to this question to truly answer it. You could take annual distributions. You could take monthly. There's pros and cons for either of those options. But realistically, how much can you take? That's the bigger question. Whether you take it monthly or whether you take it annually, all those kinds of things. What type of account is it in? It mentions it's a 401k, but is it a Roth 401k, right? So there's different details here that come in, but how much can you really take? That's the biggest piece to the puzzle. And until we've got that solved, none of the rest of it matters, right? I mean, you look at, if you've ever built a house or you see a house being built, they don't put the walls and the roof up first and then try and shove the foundation underneath. The income is the foundation. That's what all of this is founded on. And without that, a storm comes through, it's going to be blown down. And that's what we talk about each and every single week, is to make sure that you have the foundational income that you need so that you can go do what you want in retirement, because that's what it all comes back to.
Yeah, I mean, the overall theme here is it's in the details, and everybody's details are different. So therefore, you need that customized plan. So you have an opportunity to come in and talk about your details, talk about your situation. These are complimentary appointments. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call our number, secure an appointment right now. Come in and talk about your details. Do it. 866-668-3625. That's 866-668-3625. All right, our next scenario, Mark, we'll start with you. 45 years old, hospital employee, $150,000 in the 403B. They're maxing out annual contributions. They wonder if adding a Roth 403B, just that component, would provide more tax flexibility in retirement. How could a Roth 403B, here's the question, how could a Roth 403B benefit them if they expect to be in a higher tax bracket?
Yeah, well, this is a very awesome question. And it's one that I think, especially someone that's 45 years old, I want to commend them. They've saved $150,000, which is great. They are also maxing out those contributions, hopefully then getting the maximum match from the employer. Any free money that we can get our hands on, you want to take advantage of that, right? That goes without saying. But I do want to add that the Roth component, we believe, is absolutely very smart to do that, because you'll pay tax at a known rate, right? Now, there are those that may believe tax rates are going to go up. And that is, I think if we all agree, when we got $37 trillion worth of debt, taxes have to go up at some point, right? But the advantage of tax-free income on the back end, paying tax now at a lower rate, is going to be unbelievably powerful for that person. So we would absolutely say, I want clients, especially at this age, to put as much into the Roth as they possibly can. I think that's almost, I hate to say it, but it's a no-brainer in that regard, right? And I think Casey agrees with me on this, because to be able to take money out on the back end when you need it in retirement and not have to pay any tax on it, there is a lot of wisdom in doing that, right?
Yeah, it is, right? And we've talked about the pain of regret, the pain of discipline. You know what? Contributing to a Roth now is absolutely the pain of discipline, and you're going to feel it, right? When you go contribute to a Roth, your paycheck's going to be smaller because you're paying more in taxes. But future you will think very highly of today's you, right? Because it's a great decision. It really is. And you know what? even if tax brackets were to stay the same, there still can be value in using a Roth. Now, I mean, I don't think most folks believe that tax brackets are going to be the same 30 years from now. I think to me, that's pretty hard to fathom, that they're not going to go up, because they kind of have to. When you look at the debt of the country, we talked about this a lot.
Have to.
Yeah, they have to, right? And so, you know what? They're not going to right now, and that's great, right? For the foreseeable future, things are going to stay the same. But our current president will not be president 30 years from now. So things do change. And when the regime changes, those changes come into effect. And we will absolutely see that. We will feel it. It's happened in the past. And you know what? We're all pretty quick to forget certain things, right? What was it? World War II, the highest tax bracket was 90%. It's happened before. I'm not saying that's what's coming, but I do think taxes will be higher. And so if that's the case, most people would agree with that, the statement that taxes will be higher in the future. Then why not deal with the taxes now? That means that they're on sale, right? If you think about a car, let's say you're planning on go buy a new car, right? You're going to get that new car, you're excited for it, and that car is $60,000. If they come out and announce, well, next week that car is going to be $75,000, does everybody wait until next week to go pay $75,000, or do they go today and try and get it done? They go today because they recognize, in theory, in a way, it's kind of on sale. It's the same thing with the taxes on your investment accounts, your IRA, your 403B, your 457, whatever it is. Dealing with that tax now can be one of the most beneficial decisions that you make, and it opens the door for you to be more in the driver's seat when you actually get to retirement.
Just to add to that, that's why we have a CPA in our office.
Yeah.
I think that's important to really think about for those that are listening. We have a CPA that'll help us do the tax planning, which a lot of your other big firms don't even touch. If you ask them a tax question, they're going to tell you to go talk to your CPA or your tax preparer. But we don't do that here. Tax planning is a huge part of what we do for every client. So we can't overestimate the power and the importance of having somebody that can help us put together a plan. Like Casey's been mentioning, we've talked about this for decades, to help make your retirement as successful as possible. And taxes have to be addressed and dealt with to really make that plan a true success.
Yeah, you don't have a plan if you haven't accounted for taxes. That's the reality of it, right? Maybe you've got 60% of a plan, but you do not have a plan if taxes are not accounted for. And if there was no tax planning involved about how to lessen taxes and why it makes sense to do this and do that. And you know what? Roth doesn't make sense for everybody. That's not what we're saying. It makes sense for a lot of folks, but it does not make sense for everybody. It is situational, it is circumstantial, and it's worth the conversation.
Yeah, I was going to say, if you don't have taxes built into your plan, it's like that half-baked cake, right? You took it out too early. Don't do that. Have a plan. Mark, we've got spots on your calendar. Walk us through the appointment.
So if you're listening today and you just heard us talk about taxes, maybe you're a little concerned about that, you're getting ready to retire, or you've recently retired, please pick up the phone. Let's have a conversation. We want you to know you'll keep your checkbook at home, and that's all we're going to do is talk and have a discussion about taxes, long-term care. What are you going to do when it comes to when should you take your Medicare? Should you go early when it comes to Social Security, or should I wait to full retirement age, or possibly even 70? That and so much more needs to be discussed. So please pick up the phone, give us a call. Let Elevated Financial Management help.
Here's the phone number, 866-668-3625. 10 appointments. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call our number now, 866-668-3625. No cost. No obligation. You're going to gain knowledge, which is power. 866-668-3625. Another edition of Elevate Your Wealth, powered by Elevated Financial Management, in the books. For Mark, Casey, and Steve, I'm Morgan. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.